As a financial advisor, one of the most common questions I get asked is, hey, Azul, how much money do I need in order to be able to retire? And that question depends a lot, obviously, on how much you're planning on spending in retirement. So in today's video, I want to go through an example. It's a married couple. They say that they want to spend $7,500 a month. They're 62 years old. So let's jump in. I'm going to use some free online planning software so that you can follow along, you can tweak things. I want you to just watch the first time through, but at the end I'll share with you what the resource is so that you can tweak things for your situation. Okay, let's jump in. So as I said, this couple, 62 years old, married, they want to spend $7,500 a month. One of the spouses, if they start taking Social Security at 62, is going to get $1,300 a month. The other spouse is going to get $650 a month, half of their spouse's benefit. Okay, so here I've got Social Security at $2,000, just a tad over the $1,950. They're going to start it at 62. They're currently 62 years old, so they'll be able to start. The rest of the stuff I'm leaving at zero. And I want to show why I used the numbers that I did. The average Social Security check, according to the Social Security Administration, is $1,907 as of January 2024. But it's important to look not just overall, because that's people that may have waited till they were 70 as well. So this is the average by age. So you can see the average by age is a little under 1,300 at 62. So that's why I used the numbers that I did. Okay, the next part on this tool that I use is what the portfolio balance is. I am guessing that they're going to need a little less than $2 million to make this happen, but I don't know. So let's run through and see. I've got an asset allocation here of 60% stocks, 40% bonds. None of what I'm going through today is financial advice, nor are the results, right? I'm encouraging you to do this on your own as well, and more importantly, hire a professional. But 60-40 tends to be a very common portfolio allocation for people 60, 65. I'm not saying it's right or wrong. Expenses, you can see I've got $7,500. I've got inflation at 2%. Hopefully we get back down there, but you can adjust this yourself. And then the rest of this is the default, the way that the program handles taxes. So I just leave it in, but again, you can change it. Importantly, that $7,500 a month is after tax, assuming U.S. tax rules, but really just assuming the taxable portion of retirement income in the effective tax rate. Okay, the next thing is the settings. And here's really the expected returns for the stock market. Again, I left it at the default, which is 8% for stocks, and bonds at 4.5%. You might think that's high. You might think that's low. You can go ahead and change it. It passes my sniff test. It's in the ballpark, so I left it in. And then I also checked this box that says include fat tails, and that's because in the stock market, the good returns tend to happen more often than a normal bell curve would say at the extremes, and also, unfortunately, the bad returns do. So that's what fat tails are. It's just a normal bell curve that we learned about in school, and it just means it's not hugging that axis at the extremes. Okay, I did not check the black swan event. I didn't do that because I can make any plan fail, but black swan events are happening more often than any of us would expect, right? We had the great financial crisis a little over 10 years later. We had COVID. We had the dot-com bubble about 10 years before the financial crisis. So bad things tend to happen much more often than what people think and maybe what statisticians would predict. But I did not check the black swan event. You're free to do that. Okay, and then we just click solve. And you can see this simulation. I want to point out what you're seeing. The top of that light blue area, those are people that got lucky. These are the returns. This software is using something called a Monte Carlo simulation. And so you and I get one life to live. We don't know how the stock market's going to do next year or the year after that. So this software attempts to simulate that using historical data. You can see at the top, we ran 10,000 simulations. So the top of the blue arc, those are people that were in the lucky group. So, and there's even a group above that. So that marks the lower end of the 20th lucky percentile. And then the bottom group, the bottom of the light blue arc, marks the unlucky people. So 20% of the people did that poorly or worse. And then that dark blue line is the median line, which means half the people did better, half the people did worse. You can see after 30 years of retirement in absolute dollars, they almost have the same amount of money that they started retirement with. They started with 1.75 million. They're 90 years old, and it looks like the portfolio still has 1.5 million. But we all need to be worried about those unlucky folks, because we don't want to be those people. And unfortunately, the unlucky folks passed away at 86 to 87. So this probability of success is probably, I don't know, it doesn't tell me, but it's probably about 60 to 70%. I do have some clients that would be okay with something like this, but many people would want a higher level of certainty. So let's go back and change some things. And the easiest thing to change is to leave everything the same, but let's see what happens if instead of taking Social Security at 62, they start taking Social Security at 67. So that's what I did. You can see I changed how much they're getting in Social Security, because going back to that chart, the average check size for 67, which is probably full retirement age for them, is a little under $2,000, $1,884. So I assumed that one of the spouses got 50% of that, so they're getting $3,000 a month. So they waited. Now they have to come out of pocket for those first 5 years that they're retired. They don't have Social Security helping them. But then they're going to get a bigger check size. So you can see that kicks in at 67. That's the only thing I changed. And that helps out. Before, the unlucky people were running out of money between 86 and 87, and now they're running out of money a little past 87. So it helped on the margin, probably an extra 12 months, but it didn't solve the issue. Many folks would still want to have a higher likelihood of success than a 20% chance of running out of money before they hit 90. So what I did was I tweaked the portfolio size. I increased the portfolio that they had from 1.75 million to 2 million. Unfortunately, that means they probably need to continue to work for a couple more years to make that happen. $250,000 is a lot of money to save, but they also have $1.75 million helping them. So if they have a year where the market's up 10%, 175,000 of that 250,000, their money is producing for them. So let's do it at $2 million and see what happens. And this looks great. This is what we all want. There's nobody in this group that's passing away with this simulation. This is not certainty. It doesn't mean people can't pass away, can't run out of money before they pass away. But this looks a lot better. So that's the outset of it. So it looks like if you want to retire at 62, waiting to take Social Security may be in your benefit. You want to talk with a financial advisor yourself. Again, none of this is financial advice. This is a good tool. I like it. I like it because it's free and it's online and it's simple. So it's something to give you a ballpark feel. But you don't want to retire using a ballpark feel. You want to know. You want to have as much clarity as you can. And for that, I encourage you to work with a financial advisor that's a fiduciary to you 100% of the time. But this tool, I told you at the end, I would tell you so you can tweak it yourself, is Honest Math. It's at honestmath.com. So this is how you look through the financial side of it. But equally important is the emotional side of deciding, are you ready to retire? And that's why I made this video up here, Retiring at 65, that might be a big mistake. And I titled it that because I'm encouraging people to think about retiring earlier. Why? Because I want you to take full advantage of the youth of your senior years. Thanks for watching this video, and I'll see you in the next one.